Okay, so after I started this channel, a lot of you guys asked me to make a video on stock investment strategy for beginners, which I've been giving some thought. Now, the reason I gave it a lot of thought is because, number one, I was not sure how basic it'll have to be to make it understandable for everyone watching while providing some meaningful information. And number two, there's really no right or wrong strategy in stock investing. And number three, there are just too many variables and things to consider to put into a single video. So I gave it some thought and decided to make the video with the following caveats. Number one, the strategy I'm about to explain to you is the strategy which I use. Now, what I'm trying to say is that you may or may not decide to follow this strategy, as I can't really say that this is the right strategy for you. Please consider it as a playbook which you can play around with to potentially make better decisions when you're investing. Number two, I'll avoid explaining every single basics of terminologies and concepts, given they're either available in my previous videos or can be easily understood by searching it yourself. Number three, I don't do short-term trading, so please assume that my entire strategy is based on holding your investment for at least 3 months, up to a few years until you reach a satisfiable return. Now, for the people who are viewing my video for the first time, I suggest you either watch my other videos or watch this video very carefully to fully understand the logic behind it. After all, I just want all of you to learn something from this. And also, if you fully understand the concept of this video, whatever your strategy is, I'm sure you can use this video as your investment playbook to make modifications as you see fit for your purposes. Okay, caveats aside, let's get to it. To explain my investment strategy, I'll first need to explain the Federal Reserve chessboard again. So I've been repetitively saying that the most important aspect to consider when investing, especially post the global financial crisis era, is understanding the Federal Reserve's actions. Now, if any one of you disagree with this and would prefer investing in a stock in the super long term, say 10 plus years, without taking into account of the Fed policies, that is fine too. In that case, this video might not be too helpful for you, but the reason I take into account of the Fed policies is because while I don't short-term trade, I do want to maximize my profits by adjusting my investment portion and types of stocks by taking profits in a few months or 2 years maximum. Okay, I also explained that there are two major metrics which we need to monitor, with the first metric being the Federal Reserve interest rate and the second metric being the Federal Reserve balance sheet. Now, to recap this table, basically the Federal Reserve uses these two tools to control the liquidity in the market. First, on the interest rate, the Federal Reserve can guide it towards being low or can guide it towards being high. Now, if the interest rate gets low, there are two implications which happens. First is, in general, the market's valuation will go up. Now, when I say valuation, I'm referring to the typical valuation metrics like the price to earnings ratio and EV over EBITDA multiple. Now, let me try to explain why this happens. You might remember from my DCF video, which I made as a joke trying to value dating, that when I discounted the cash flows, I used a thing called a WACC. Now, you may remember that the WACC is composed of two things, which are cost of debt and cost of equity. Now, simply put, cost of debt refers to the interest rate the company needs to pay when borrowing money. So if the interest rate goes lower, cost of debt becomes lower. Also, on the cost of equity side, if the interest rate goes lower, a core component of the cost of equity, which is the risk-free rate, which is essentially the US Treasury yield, will also go lower. So you can safely assume that the WACC will go lower if the interest rate goes lower. Now, you're using this WACC to discount the future cash flows of the company. Therefore, if the WACC goes lower, the value of the cash flows will go up. To give you a simple example, if the company is projected to generate $100 of cash flow next year and the WACC is at 10%, the current value of the $100 would be $100 divided by 1 plus 10%, which is $90.9. However, if the WACC goes down to 8%, the $100 divided by 1 plus 8% becomes $92.6. Therefore, the future cash flow of the company will be valued higher. which leads to a high valuation of companies. If the value of the companies goes higher, it'll lead to the price to earnings ratio, or EV over EBITDA multiple, also going higher, because the absolute earnings of the company is fixed while the value goes higher, leading to a higher multiple. Now, the second reason the company's value goes higher is because if the interest rate goes low, interest on bonds will also go lower as well. Now, I don't think I need to explain why that is. Basically, lower interest rate would mean that you'll be earning less interest on a bond. So what generally happens is, because the bond interest rate becomes low, the investors will generally avoid investing in the bond and look for a high-yielding asset, like stocks. Therefore, the demand for stocks would increase, leading to a high valuation of stocks. Okay, so that's the first thing that happens. The second thing that happens is, if the interest rate goes low, all companies' debt burden will be significantly reduced. Now, when companies take on debt or issue bonds, companies will need to pay interest on them. Now, if the interest rate goes low, companies with a lot of debt will be reduced with the burden of paying interest on them. And even if companies don't have any debt, they'll be less reluctant to take on the debt because interest rate is very low. Now, under this scenario, which companies do you think will benefit the most? Basically, the companies which are expanding rapidly and growing rapidly will benefit the most. I mean, companies which are not growing and only full of debt will also benefit, but I'll not go into those companies because we shouldn't invest in those companies. Okay, so going back to my point, the companies which are growing and expanding with a lot of debt, with not much money because they're not generating profits, will benefit the most. Okay, so those two are the biggest things which happens when the interest rate is low. Now, if the interest rate is high, it's the opposite. Market valuation will go down because WACC goes higher, and there will be some shift from stock investors to bond investors. Also, companies with high profit and cash flow will benefit. Obviously, high growth companies are always good, so I won't put that down here. Okay, so we covered the interest rate. Let's move over to the Federal Reserve balance sheet. Okay, so if the Federal Reserve balance sheet is increasing, this means that the Federal Reserve is buying assets and increasing their balance sheet. The assets which the Federal Reserve buys are mostly treasury bonds and mortgage-backed securities. Basically, you can think of the scenario as the Federal Reserve conducting the quantitative easing. Now, under this scenario, I explained in my whether QE and bailout should be allowed video. Basically, two things happen. First thing that happens is, because the Federal Reserve purchased so much bonds from financial institutions, these financial institutions receive so much cash in return that they become extremely eager to lend the cash to people and corporates. So obviously, the first thing that happens is it becomes extremely easy to borrow money. Now, as I explained in my previous video as well, because these financial institutions are so eager to lend money, money becomes extremely cheap, and people can borrow at a very low borrowing rate. So that's the next thing that happens. The borrowing rate becomes very low. Okay, now, if the Federal Reserve balance sheet decreases, you can think of it as a quantitative tapering scenario. Basically, the Federal Reserve is draining the money in the market and sucking it up by either selling the bonds to financial institutions in return for cash, or just not doing anything and letting the bonds mature. So under this case, it'll be the opposite of the balance sheet increasing case. So basically, it'll be harder to borrow money and the borrowing rate goes higher. Okay, now, up to this point, we have covered the implications of the Federal Reserve policies. Now, let's move over to the actual stocks. So let's assume there are 4 stocks: Stock A, Stock B, Stock C, and Stock D. Okay, so when looking at a stock, while there are millions of things you should be looking at, if I were to pick 4 major metrics to look at, those would be, number 1, revenue growth, number 2, earnings growth, number 3, forward price to earnings ratio, and number 4, debt to EBITDA ratio. Okay, now, please keep in mind that I'm just giving some examples of stocks just to give you an idea how you can play around with the stocks in accordance with the Federal Reserve environment. Now, revenue growth is straightforward. Also, earnings growth is straightforward. Basically, you just take next year's earnings and divide it with last year's earnings and see how much growth the company is recording. On the forward price to earnings ratio, please refer to my price to earnings ratio video. I just want to emphasize that for the price to earnings ratio, you should not look at trailing price to earnings ratio. For example, right now it's early 2025, so don't use the price to earnings ratio by using the 2024 earnings, but use 2025 year-end expected earnings to derive the expected price to earnings ratio. The reason is, number one, the investors generally care about what will happen to the company's future earnings as they're forward-looking. And number two, historical earnings can be heavily distorted due to one-off earnings or losses. Okay, on the debt to EBITDA ratio, the only reason I look at this is because I try to find out how much leverage the company has. Also, the level of leverage a company has become increasingly important given the drastic monetary and fiscal policies which the Federal Reserve is adopting these days. Basically, the level of debt a company has would drastically determine the company's valuation level given the interest rate they pay on the loans, and their ability to refinance the loans can get significantly easier or challenging depending on the Federal Reserve policy environment. Now, EBITDA is the most representative metric which the company generates from its operations as it adds back interest, taxes, and depreciation and amortization. So you can just simply think of it as a free cash flow metric, which the company generates every year. Now, by looking at the debt to EBITDA metric, you're able to figure out how many years the company will take to pay down its debt. Okay, so starting with Company A, let's assume that Company A has revenue growth of 5%, earnings growth of 5%, price to earnings ratio of 10x, and debt to EBITDA ratio of 1 times. So basically, Company A has humble revenue and earnings growth, but is trading at a very low valuation of 10 times price to earnings ratio, and its debt to EBITDA is at 1 times, which means the company has almost no debt. So the Company A is very stable company with little growth and no debt. Okay, for Company B, let's assume that Company B has revenue growth of 10%, earnings growth of 10%, price to earnings ratio of 20 times, and debt to EBITDA of 3 times. So basically, Company B has some growth, but is trading at a slightly higher valuation of 20 times price to earnings ratio, and its debt to EBITDA is at 3 times, which means the company has some debt. So Company B has okay growth, slightly high valuation, and some debt. Okay, for Company C, let's assume that Company C has revenue growth of 20%, earnings growth of 10%, price to earnings ratio of 25 times, and debt to EBITDA of 5 times. So basically, Company C has high growth, but is trading at a high valuation of 25 times price to earnings ratio, and its debt to EBITDA is at 5 times, which means the company has high debt. So Company C has high growth, high valuation, and high debt. Okay, for Company D, let's assume that Company D has revenue growth of over 50%. It could be 80% or 100%, but let's assume it has a very high growth profile. Also, Company D is recording losses, so there's no such thing as an earnings growth or price to earnings ratio. Let's also assume that Company D has a huge debt. But given the company doesn't have any earnings, its EBITDA is also negative. So debt to EBITDA can't be calculated. Okay, so let's go back to the Federal Reserve chessboard to see which stock we should buy in each of the periods. So let's start with the fourth quadrant, which is the least liquid period. Basically, the interest rate is high or getting higher, and the Federal Reserve balance sheet is decreasing. Basically, very little liquidity is in the market. Okay, during times like this, in terms of making the investment, I would personally not invest over 20% of my cash or even just sit on the sideline to observe the market. I would think that this would be a very risky time to invest given the stock valuations are getting lower and getting loans is not easy for companies as well. But if I had to choose a stock to invest during this period, I would choose stock A. Now, the reason I'll choose stock A is because despite the low growth the company is recording, the low level of leverage which the company has will keep the company solvent. Also, given the company's valuation is already very low at 10 times, the increase in the WACC will not impact the company's valuation that much. Basically, if your nominator is high, increase in the denominator will have a much significant impact in absolute terms. Now, percentage-wise, it may be the same, but my observation on the market is that if a company with high valuation multiple is impacted by increasing interest rate, it'll trigger the sell-off mentality of the investors and the stock may experience a huge drop. So to play safe, I'll prefer investing in stocks like Company A. So let's move on to the third quadrant, which is the in-between period. Basically, the interest rate is low or getting lower, and the Federal Reserve balance sheet is decreasing. Basically, there's some liquidity in the market. Okay, during times like this, for the investment, I would personally not invest over 50% of my cash. Or, same as the fourth quadrant, I'll just sit on the sideline to observe the market depending on the circumstances. I think you will need to invest in stocks quite selectively during times like this too, given liquidity is still there, but not always there. Okay, for the stock, if I had to choose a stock to invest during this period, I would choose stock C. Now, stock B and stock C would both work, but I would prefer stock C. The reason I would prefer stock C is because Company C has high growth, which would definitely be valued in the market, but also has high leverage. Now, assuming Company C already has enough debt it needs, it'll benefit a lot from the decreasing interest rate. Now, because it has enough debt, it won't have to borrow a lot of new money and just refinance the existing loans, so it would work even under an environment when the Federal Reserve balance sheet is decreasing. Also, while the valuation of Company C is quite high, as long as it can maintain the revenue growth, its valuation will be justified given its low interest rate environment where the WACC is going lower. Okay, so let's move on to the second quadrant, which is also the in-between period. Basically, the interest rate is high or getting higher, and the Federal Reserve balance sheet is increasing. It would be similar as the third quadrant, but slightly different in the sense that the interest rate is high. Okay, during times like this, for the investment, same as the third quadrant, I would personally not invest over 50% of my cash or just sit on the sideline to observe the market. Again, I will need to invest in stocks quite selectively during times like this as well. Okay, for the stock, if I had to choose a stock to invest during this period, I would choose stock B. Now again, stock B and C would both work, but I would prefer stock B. The reason I would prefer stock B is because Company B has some growth, which is okay, but also has some leverage. Now, given Company B has some leverage, but not as much as Company C, it should be relatively okay under a high interest rate environment. And also, while price-to-earnings ratio is somewhat high, but it is not as high as Company C's, so the impact from the WACC going higher would be relatively controlled. Okay, now let's move on to the final quadrant, which is the first quadrant. Okay, now in this quadrant, I will super aggressively invest into the market. I mean, I'll not only invest 100% of my cash, but if possible, even take on loans to invest. Basically, this is a period where the Federal Reserve is decreasing the interest rate and conducting the QE at the same time to increase its balance sheet. Also, in terms of the stock to invest, I will invest in stock D, which is recording excessive growth with no earnings. Now, as I said multiple times in my previous videos, this is the time when the companies rarely go bankrupt. So you do not need to worry about the amount of debt a company has, given they should be able to either refinance the loan or get more loan from the bank. Also, the financing cost is extremely low, so the company would not have any issues in paying the interest with more debt or equity. Also, given the low interest rate, this is the time when people hunt desperately for growth. All the money in the bond market will shift away to stocks, and given there's so much liquidity, they'll just look for fast money where the growth can be achieved. Okay, so I'll invest in Company D during this time, but I will make one single caveat though. For a stock like Company D, you really need to exit the investment at the right time. When you feel like you gained a lot of profit, or when you feel like there's any, and I mean any signs of the interest rate going back up or the quantitative easing ending, you have to sell the stock right away. Don't get swayed away with the media or Wall Street bets screaming to the moon or whatever. Just sell. 20% profit, 50% profit, 100% profit, 200% profit. These are all great. Just hit the sell button whenever you see any signs of any changes happening in the market. Okay, guys, to wrap up, I'll note a few things. Please listen carefully. Number one, a stock with company D's growth and company A's valuation and leverage ratio would be the best in all scenarios. If you can find a stock like that, go for it. However, there are not many companies like that out there. So that's why I'm giving these illustrative examples with made-up companies. Number two, when you pick a stock, please compare it against other companies within the same sector. Try to check whether the company's valuation or growth is lower or higher versus its peer companies and take that into consideration when investing. Number three, don't chase for fast money. The more you chase it, it'll run away. You don't have to invest and hold a stock for 20 years, but at least say bye-bye to your cash for the next 6 months or 2 years when you buy a stock. It may go down in the short term, but if you did your work, you have the chance of succeeding down the road. Okay guys, so this is the end of my investment strategy video. But now, I do want to emphasize again, and please listen to this. This strategy is my strategy. It may work for you or may not work for you. But if you understood my points correctly, you will learn something from it, and you should be able to use this information in your own way to make your own investment decisions. Now, the reason I made this video is to help you make better decisions. So I really hope all of you guys succeed with your investments down the road. Thank you, and I'll be back with more videos very soon.